Well, welcome. Thank you for sticking around for this panel. We are going to be talking about the institutional landscape for crypto, and I'm joined today by some distinguished guests in the industry. We'll do some brief introductions and dive into the questions pretty quickly. For those of you who don't know me, I'm Jeanine Hightower of Bagkt. I'm the Managing Director of Operations at Gemini. We are a New York trust company that operates a custody solution for institutional investors, as well as a spot market for both institutional customers and retail public at large. I'll turn it over to the panel here to introduce themselves.
Hi, everyone. My name is Sunayna. I'm the head of digital assets and DLT at TD Ameritrade. I'm very proud to work for a firm and lead this sort of firm that not only hearts blockchain, but also Bitcoin. So the mandate for my team and I is really how do we look across that spectrum and find meaningful ways to commercialize the technology, but then on the other end of the spectrum as tapping into this emerging asset class and finding the right ways to bring it to the clients that we serve, which is over 10 million retail clients in the US and in Asia, and approximately 10,000 advisors. And we really take a three-pronged approach. One is, what are the products and services we're uniquely qualified to build and render to this core group of clients that we have the privilege of serving. The second is really partnerships and investments in this ecosystem, as in the same way that over the last 40 years we helped build the infrastructure around traditional capital markets and kind of democratize investing. How do we help bring some of that same hygiene, discipline, and scale? And then the third vertical that Kathy touched on and near and dear to our heart is really education, and which I'm sure we'll double click into throughout the panel.
Hi, John Conneely. I'm leading custody sales at Bakkt, and Bakkt is the new venture supported by ICE, or Intercontinental Exchange. And for those of you not familiar with ICE, they are a $54 billion public company that owns and operates a dozen or so exchanges around the world, including New York Stock Exchange. In terms of Bakkt specifically, what our mission is, it's simply said to expand the access to the global economy by, one, building trust in digital assets, and that's where you see a lot of our institutional trading and custody products in the market, but also two, unlocking the value, and that's where you see a lot of the work behind the scenes on the consumer side in partnership with our launch partner Starbucks, which we'll be sharing more about in 2020. But I think what's core to those two components of our mission is really the secure storage of digital assets. So I think there's one key takeaway I can give you today on Bakkt is that Bakkt itself is not a new exchange. At its core, and every kind of future product that we'll be launching revolves and requires custody. So Bakkt at its core is really a digital asset custodian.
Good afternoon, everyone. So I'm Chris Baker, part of the Fidelity Digital Assets team based here in Boston. We're pretty lucky internally, I think Kathy mentioned it. Abby Johnson, the CEO of Fidelity, she took a liking to Bitcoin, particularly back in 2014. And that really, interestingly enough, came through a scenario planning analysis. So we were looking at what could be potential disruptors and opportunities for Fidelity over the next 5-10 years. And Bitcoin was a resounding answer from both our consulting team and our incubator in-house. So she just took off and ran with it. So started mining, started figuring out what are ways that we could grow the industry. I think there was two avenues we could have taken. It was the retail side, which many people are familiar with Fidelity branches and how big of a reach there is there. But we thought more importantly, the institutional side needed a bit more growth, a bit more help as far as making it more mainstream, making it more accessible for institutions. So what we did in 2018, we launched our Fidelity Digital Assets business. So it's a wholly owned subsidiary of Fidelity. And we are offering institutions secure custody of Bitcoin, and then also an execution services platform that sits on top of that. So we work with the full spectrum of institutions from RIAs, family offices, hedge funds, pensions, endowments, and all the likes that Fidelity's already worked with and built trust with for many decades. Now we're just trying to do that for a new asset class with Fidelity Digital Assets.
Hi, I'm Peter Najarian. I'm the Chief Revenue Officer at BitGo. We are a 7-year-old company that started as a non-custodial hot wallet technology provider and have now grown to a qualified custodian as well. We are, it's interesting to be on this stage with such big brands, and as an enthusiast in this ecosystem, it's great to be on this stage with such big brands because it proves the adoption is coming. We are a little bit different in that we're one of the originators of the technology. the wallet technology, and as a function of that, remain one of the largest in the space. I think we have API connectivity to over 150 exchanges today that use our products, and probably greater than 50 market makers globally. As much as 20% of the on-chain Bitcoin transactions that took place in the past 12 months went through our wallet. So we're excited to be a big part of the growth, and we really are excited to have brands like this diving into the space in the way that they are.
We've got quite a varied group of participants in the institutional markets today on the stage. And so one of the biggest questions I have for everyone on the stage today is, what does it take for institutions to allocate more capital to crypto? What are some of the structural problems in the market today that exist? What's being done to solve them? And what is your firm specifically doing to solve them? And maybe we'll start with Peter, since he's got the microphone already.
So I think, first off, it feels a little bit like, and this is with great respect to the folks who put on this event, it's a great event, but it does feel a little bit like we're all in kind of an echo chamber talking to ourselves. And it felt that way at Consensus recently, at DAS recently. It's starting to feel like this is a conversation that hasn't grown even close to the way we expected it to grow. I hear that from our board at every board meeting. When do you expect the institutions to finally come? That used to be, what's the plan to be ready for the scaling of the institutions when they come? Now it's, when are they coming, which really the bubble over their heads is, are they ever coming? I think it's a few things, and they've, many of which have been touched on already. I think regulatory clarity matters a lot. And until we see it, and the path to get there is challenging for sure. Until we see it, I think we're challenged. I think the volatility my whole background is in institutional markets. I came to crypto only 3 years ago, after a long career in traditional finance. And I think this level of volatility scares them to death. And the bulk of my career was in emerging markets, which was considered the high vol location to be. And I think this vol, you can argue, yes, if you bought, let's use Bitcoin as the index. If you bought Bitcoin at the right time, it's only gone higher. Where you bought matters a lot. And if you bought in the wrong windows, right, there have been some momentary periods of spiking, and then there's been a fairly steady drain in between. And institutional investors aren't paid to be hodlers, so this level of volatility is a really difficult thing for them to get their heads around. Third, I think valuation metrics matter to institutions. They've got to be able to tell to make it clear to their investment committees why they make the investments that they make. And often they rely on tools that are tools used throughout their organization. Those tools don't really apply here. And fourth, this whole concept of private keys and security and custody and all of that is so foreign to them. The concept for an institutional investor that everything in traditional finance is reversible, but everything in crypto is irreversible, gives them great pause and puts them at great risk. So the things that we're doing to try and solve all that, I think, are all similar, I would imagine, on this stage. I think we're trying hard to be leaders with regulators. I think that there's a big chicken and egg reality with regulators. The regulators aren't going to show up until there's massive demand for them to show up. And until they show up, there won't be massive demand. So how do we overcome that? I don't know. I think volatility smooths over time. We're trying to do our part to provide the tools for exchanges to work together and for that kind of network effect to happen in a way that smooths volatility. Valuation metrics, I'm not even sure where to comment there. Security, I think the fears about security are mitigating all the time. And I think that there are two reasons for that. One is if you're an institutional investor that's going to make an investment in crypto and give it to someone to hold on your behalf, I think your decision tree is really quite simple. First, who's the most secure? Second, who's got the biggest balance sheet I can sue if they're wrong? And we think that we're the most secure. I'm sure everyone on this stage feels the same way about their own technology. We think we've got the longest track record to prove it. But thankfully, you don't have to rely on us and our security, because now you've got a lot of big balance sheets up here that you can sue if we're all wrong. So
Chris, with that, do you want to tell us what Fidelity, with its enormous balance sheet,
Yes.
is working on in the space to support institutional customers.
Absolutely. So I mean, I think obviously Fidelity does have a big balance sheet, but I think it becomes bigger than that. And I think what happens is Fidelity's clearly made a commitment. I think it's very simple, but I think it's telling, the fact that we put our name on it. It's Fidelity Digital Assets. We're proud of what we're doing. We're excited about the commitment to the space. And I think everything that Peter mentioned is exactly what we're feeling, exactly what we're hearing: regulation, valuation, reporting. But I think a lot of it boils down to trust and education. So Kathy mentioned education. I think that's a huge one. Something that we are building and continue to develop. I look at Ria Vittoria, who's sitting here. She's our director of research. We're starting to develop more of a framework of how do we position assets for traditional investors to go back to their board or go back into their investment policy statement and feel comfortable. Because they have to feel comfortable and rep to their clients why I've made that allocation. It's not an easy thing to do. It's extremely hard with the amount of volatility. So how do we build the infrastructure and give them the avenues to actually be able to access that? I think Bakkt is doing a great job with that, with different ways to express a position in Bitcoin. So you can have futures, options, or spot. And then additionally, it's all of us up here providing secure custody. So that's where the trust comes in. That's to all of us from what we surveyed at Fidelity. We heard it loud and clear from the institutions. Even if I wanted to hold the asset, I don't know where I would hold it. I either can't legally hold the private keys or I don't feel comfortable. And a lot of people don't have the technical expertise. So as a custodian for institutions, we're taking that onus off of them and allowing them to provide a third-party custodian the option to hold those keys on their behalf. It's not for everyone, but for institutions, that seems like the avenue that they would need for that to be an able position in their portfolio.
Chris, I have one more follow-up question for you. So you mentioned one of the questions that we had on our pre-list was talking about valuation, and since you've mentioned it, I'll just touch on it right now. How do you address that, especially for this room of investors? How do you, and Fidelity in particular, that has a very large research organization, provide guidance on how you value one of these assets? I think that's one of the underscoring questions of the day.
Yeah, I think it's complicated. I think anybody that's looked at the space, it's not clear. There is no regulation around price and what there is as far as a best price out there. So for Fidelity, what we're trying to do is really take the framework reviews on the traditional side and try to come up with and establish what we're considering a Fidelity best price. At this point in time, we feel like that's the best way that we can offer execution quality to clients. So while it's not fully baked, and I think it's a something that's going to continue across the market, valuation reporting, and I think Kathy was the one that mentioned it, the line item. It seems like a simple thing, but on reports, people don't want to have a separate line item, whether it's for GBTC or for a private holding of Bitcoin. So how can we make it feel and look the same as it does in the traditional world, but it just be a new asset class? I think that's paramount to all of this.
And John, you have a very new brand for a very old business. So tell us a little bit about what Bakkt is doing, how it's differentiated from NYSE and the ICE brands, and how you are catering towards institutional customers.
So Bakkt is, we sit right alongside New York Stock Exchange. Our majority owner is ICE. And what's unique about that is it gives us a lot of, or allows us to pull from a number of resources, both on infrastructure, trading, security side, and we leverage a lot of those on the operational side as well. We leverage that for the Bakkt Warehouse, our custody solution, but also that partnership allows us to facilitate in our first product the trading of a physically delivered Bitcoin futures contract. And why we think that is important, and kind of one of the reasons I do think that a lot of institutions are still on the sideline, is that there is a need for greater price discovery or an efficient price discovery. So I think largely today you're seeing that price discovery occur in the unregulated spot markets. I think those markets are extremely important. I don't think we all would be here today if they haven't come about the past 5 or 6 years and really grow the space to where it is as meaningful as today. But I do think that price discovery will ultimately move into more of an end-to-end regulated ecosystem and allow for that greater efficiency of price discovery. And I think the CME has made great first strides in that with their cash-settled Bitcoin contract. They've seen tremendous growth. It trades on a trusted, federally regulated exchange, clears through federally regulated clearinghouses. And we speak to customers on a daily basis who want asset exposure but don't want to own it, and that's really where the cash settled contract works great. But it's our belief that there's still institutional investors still on the sidelines waiting for that physically settled Bitcoin futures market to develop, because that price discovery occurs in that end-to-end regulated ecosystem, and that price of Bitcoin is not reliant upon any data from the unregulated spot market. So that's exactly what Bakkt and ICE has built for its first product. So Bakkt is providing the custody for ICE Futures US, the federally regulated exchange, and ICE Clear US, the federally regulated clearinghouse, to facilitate the trading in this physically settled Bitcoin contract. And it looks like any other ICE contract. It trades right next to sugar, cocoa, oil, and we like to just tell customers, think of it as like a corn contract. It's the same processes, same infrastructure, same front ends that they are used to. We're trying to make this contract look and feel as much like any other product that they're used to. But ultimately, if the trading participant would like to go to delivery on these contracts, that Bitcoin is then stored in the Bakkt warehouse, which is regulated by the NYDFS. So that's truly creating that first end-to-end regulated ecosystem for price discovery, and we think that we'll continue to grow that market and over time, but hopefully get that to a spot where it is really the true benchmark price of Bitcoin.
So TD Ameritrade has, as you mentioned, a giant framework for wealth advisors and financial advisors. What are you doing to support this space for your customers that are looking to support their customers and getting into crypto that have interest? I know one of the themes that we all experience in our daily lives is customers that are interested in getting into crypto and trying to figure out how to do that and wanting to rely on their traditional partners to get into the space. So tell us a little bit about what's going on in your world.
Yeah, absolutely. And I think you'll start to pick up there's, it's very symbiotic with a lot of what my colleagues have said here. So I think the framework with which we make decisions for this ecosystem, whether it's our product roadmap or whether it's making an investment or forming a partnership with some of the folks represented here and others in the room, is really predicated on three things. One starts from a place of, what is our core competency? What is that strength that we can help bring into the ecosystem and make a meaningful dent? And whether it's us or our friends at Fidelity and other brokerages, for 40 years we disrupted traditional wealth management and kind of built a lot of the infrastructure and really brought Wall Street to Main Street. So how do we take a lot of those rails that are in place but bring it to crypto in a way that can help scale up? I liked the point that Kathy's colleague made, is often the question is, well, when are the institutions coming, and are they ready? One of the things we worry is the infrastructure, the security, the liquidity already. Like, I don't want us to be the one that somehow breaks Bitcoin or something, because we just bring this massive scale without being prepared. So we start from a place of core competency. And then the second thing we really look at is, what is the problem we're trying to solve for? And that may be more on the blockchain side of things. Like, I'm not interested in blockchain theater or chasing a shiny object. And, yes, there's a lot of work being done in the blockchain space, but let's be honest, there's yet to be a panacea. Cryptocurrency is kind of the killer app, as people like to say. But the third thing in our litmus test, which is probably overrated or overweighted, and rightly so, is the voice of the client, right? Not just the voice of the client, but being very maniacal and focused about who is the client that we are catering to. We're not catering to the client that wants the Binance experience, and we're okay with that, right? Our client, their core attributes are high net worth, but very sophisticated and has that independence gene that they want to take charge of their money and make it work for them. The other key attribute about our clients when it comes to crypto is they're probably largely in the curious category. They're intrigued, they're reading about it, they're kind of going through the same struggle we all went through when we first discovered Bitcoin. That's where education becomes critical. So we have an opportunity to guide them in the right way versus falling for a charlatan's video on YouTube and doing something crazy, or reading perhaps somebody who's not friendly to this ecosystem and kind of forming their biases. And then the third key attribute of our consumer for whom we're designing our products is they are largely coming into digital assets with a very pragmatic viewpoint, right? There's many of us in the room who likely came in and fell in love with the ideology, and that spurred a chain of events for us, and that's great. Many of our clients share that. But for a large part of those curious clients who are getting converted, they're coming in because they see it as a good form of diversification, potential uncorrelated alpha, that's a TBD, potential safe haven asset rhetoric that we're seeing. So that's really how we form the basis of what we will build, how we will build it, where and to whom we will distribute it, and also who, and also recognizing, listen, there are things that we're really good at, and there's things that, we have no business trying to do it ourselves. Who are the right partners or, startups that we can invest with? So I think that is super helpful. There's a lot of noise in this ecosystem. It really helps us focus and do the things that, so from our product roadmap perspective, my nirvana and towards which we're building towards, it's not gonna happen tomorrow, is just as my client comes in and logs into our platform today and there's their fiat portfolio and all the different choices they have to engage with traditional capital markets. Hey, if you're an ETF person, great. If you want to do crazy sophisticated options and futures, good. We're gonna give you everything with credible education and you made the end decision. I would love for a parallel crypto portfolio to complement that with the same level of choice and sophistication and education, so they've got everything they need to do what's best for them.
So I think it's pretty interesting, having listened to what the panelists have said so far and thinking about the last panel, which I had particular interest in, not just because my colleague was on it, but because we spend a lot of time thinking about regulation in this space, and we operate, for those of you that are newer to the space, in a tangled web of regulatory matrices, often that are very absent. The exchanges, the spot markets tend to operate under state regulation. There's some nascent federal regulation. The SEC has been pretty hands-off in this, as we've discussed earlier. And it makes it really complicated for the industry to extend beyond sort of the direct-to-retail public. And I think a lot of the more established institutions really need a broader regulatory framework that's more comprehensive to really dive in. The last panel was interesting because they spoke to a lot about enforcement, and I think the takeaway that I wrote down anyway was that nothing big is going to be happening this year in terms of that. So I'm curious from the panelists, so Sunayna and John, that sort of operate in a super regulated space, and also from Chris and Peter, who operate more like a traditional crypto market. What are your thoughts on regulation? What are our biggest challenges in that space, and how do we go about getting those solved?
The regulation questions, it's my favorite FUD that I love to get into debate with maybe a no-coiner or semi-coiner is, but crypto is not regulated. I'm like, really? For something that's not regulated, I seem to be spending a lot of time with lawyers and my chief risk officer and regulators, and I went to law school thinking I would actually never use it, and it's actually coming in handy. So, but at least it makes my parents happy. So I think the regulatory ambiguity is definitely something that's in construction. A sidebar, and it'll come back to it, is over the holidays I was on a bit of a biography binge, and I'm not pitching for their books because I work for them, but I happened to read the biography of Schwab and Ricketts, which just happened to come out at the same time, just because I didn't grow up in this industry, so I was curious. And if you had just, word select online brokerage and remove that from their biographies and just read the entire narrative, you would think they were talking about building a crypto industry, right? And it was very analogous to my own surprise that some of the same things that we are struggling with or dealing with, like when the online brokerage industry was created, they had to go to the regulators and get, SEC no action letters because there was a lot of things they wanted to do or the clients wanted that there was no regulatory regime. And from an incumbent perspective, and some of the startups in the room will appreciate it, is the incumbents of that day, the wirehouses, would actually use marketing campaigns to call these new brokerage firms discount, but as a pejorative. Oh, you don't want to deal with them. I mean, again, does that sound resonant? As we talk about crypto and the incumbents are throwing shade at us. Anyways, it's an interesting read, and history is always educational, but it kind of reminds me that, yes, we're going through these struggles, but they're nothing that we haven't gone through every time we've had to create something. So I think a lot of the work that's happening, it seems slow and steady, but I wish the SEC would sign off and give us clarity. I think as we push for it, the other thing I'll just kind of say, and these guys can double click, is we also want to make sure that the regulations are common sense, that we're not designing for that lowest common denominator, that there's a balance of clarity, but also common sense. Problem with common sense being it's not all that common. So
John, what are on your wish lists for regulatory clarity?
Yeah, I mean, I think that's something that we're always constantly thinking about. Not sure if I have any specific ones on my wish list, but just at a high level, I mean, I do think that institutional investors, the questions that we're getting are not much so surrounding custody or trading. I think they're largely comfortable with that. I think we're starting to see more and more questions regarding our regulatory approach and audits and things of that nature. But I do think that we have to be cognizant that at a high level, regulators are going to move at a pace that they're comfortable with. And a lot of the work that we are all doing on stage is very much in partnership with them. So we're educating them, what a hard fork is, what a deep chain reorg is, why is one mature blockchain or why is one public blockchain mature enough to support and another one isn't. But it puts us in a unique position because we're also startups. We need to move fast and ship code, execute, and deliver. But I think ultimately it's not going to be, or I don't think the winners and losers in this space will be decided overnight. It's going to occur over years and decades. So I do think that regulatory clarity is something that we're always focused on, especially as regulated entities. So I think that's something that's really core to all our businesses.
Chris, I have another question, if you don't mind changing topics. So volatility is a reason why a lot of traders get into crypto, and we certainly have a lot of traders in the space that are often our largest market makers, but it's not often a reason why investments come into the space. What's the right level of volatility? Do you think volatility in Bitcoin in particular is holding investors out of the sector, or what do you think is the right level for volatility?
So I think, every asset class is going to have some volatility, whether it's emerging markets or the crypto markets. But I think the right level is, a little bit tough for me to say. I think each investment team has their own decision around that. But what I think we see at Fidelity, at least, is it was a main concern. When we surveyed institutions, it was regulatory uncertainty and price volatility. But I think part of that comes from it is a little bit of an easy out. It's an easy reason to say, I don't want to learn about the space. I don't want to see, potentially what the value is behind it. Where I think we see it, at least with our clients and those we work with, the majority of them are long-term investors. Fidelity's in this for the long term. We're working with those that are looking to hold for the long term. So generally our framework is more of a long-term approach rather than more of the tactical approach, if you will, those in, kind of arb trading or whatnot. With that being said, I think we have to create that safe environment for them to get the exposure and allow them to hold the asset without one day seeing it, up 20% and down 30 the next day. And quite frankly, that's a bit of why we probably steered clear of going down the retail path right off the bat. We think institutions are probably a little bit more ready for the adoption, although the retail side has already adopted it. Quite frankly, the Fidelity team, I think, opening that up to all 401ks and all IRAs that are held on the Fidelity platform might be a very risky opportunity. So as far as volatility goes, I think we understand it's still out there, but I think the infrastructure that's being built over, quite frankly, 2019, I think was a huge year in a very quiet way, with a few major businesses coming online and a lot of the infrastructure that was put in place. I think it's going to start to lessen that volatility over time.
Thank you. And Peter, to kind of wrap up our formal questions before we get to our quick speed round, tell me, what do you think is the tipping point for institutions to get into this space, sort of, feet first and diving in? What do you think needs to happen?
I think, first of all, I think the vol issue is a big issue. I think that down 80% in a mid-cap stock that's 2% of your portfolio is a rough year for an institutional investor. Down 80% in the index of an asset class is a whole different thing if you're an institutional investor. So I think it's an issue, and I think it's going to take time. I think there isn't. I also was a believer in this notion that we were going to have some tidal wave of investment, largely because the experience I went through in emerging markets really turned into a tidal wave. It took about a decade, but the amount of capital that was allocated into emerging economies, and I was lucky to have a front row seat, was a staggering amount of capital. And I had the assumption that was going to happen here in some quickened pace. I don't know if I hold that view anymore, and I think it's for a couple of reasons. I do think institutions are coming. I do think I'm a big believer in everything we're all doing, so please don't think I'm suggesting otherwise. But I agree that the rallies are going to be challenging, and they're not going to be challenging because they're rallies. They're going to be challenging because when institutions, if a sovereign wealth fund, as Kathy suggested, put 5% of their assets, and a small sovereign wealth fund, I can tell you from what we see in the market, and we see a lot of the flow where we sit, the price action of Bitcoin would be staggering. And I don't think that's really recognized in this room, and it's my bias, and I absolutely couldn't be wrong. But this is a market where you have, at the moment, a lot of retail trading regularly, and a lot of high-frequency traders, which we're calling institutions trading regularly. This isn't a market where we've had a big influx of traditional capital that comes in a big way. A little bit of that will have a big, big impact on this market. And so what is an institutional investor to do when they finally have enough FOMO and they finally get through committee enough to make that investment, and Bitcoin's at 62,000 a coin? What does that institutional investor do? Does he still buy? He or she still buy? I don't know, but I suspect that the path that this notion that we're going to get to some quick and smooth smoothing of the volatility is, I think, a false notion.
Great. So quick speed round. We'll start, Pete, with you since you've got the microphone. Quick answer, time horizon for institutional investors to dive in and allocate to crypto.
I think it's, depends on what you consider dive in, but I think it's not in 2020, and I think it's likely a meaningful appetite from institutional investors coming in a real way is in 3 to 5 years.
I think slowly we're seeing it already. I know that kind of contradicts what Peter's saying, but I think in a very quiet way, I think there are some institutions that are getting comfortable with it and making allocations. And quite frankly, they don't want to make a lot of noise around it because they don't want a lot of people to necessarily know that they've made that splash in. I'm not saying it's a tidal wave by any means, but I don't know if putting a year on it is accurate, but I think a few years out, whether it's 3, 5, 7, I think there will be a day that 4 of us, 5 of us up here will look back and say, like, the institutions are here. I don't think it's going to all happen at once and we're going to feel it, but I do think at some point we will look back with fond memories and all of a sudden realize the institutions are in the market.
Yeah, I would agree. I think I'm a little more hopeful that they're entering into the space in a meaningful way in a year or two. I think, largely we all have been speaking to them for probably a year and a half now. Very long diligence processes, internal approval processes. So I'm hopeful that those start to get solved on internally on their end, because I do think they are comfortable with kind of the landscape, or at least the infrastructure that's in place today. So I do think we'll start to see some of these institutional investors move in a meaningful way in 2 years or so.
So the question of capital coming in, I would largely agree with what they said, so I'll take a different angle on capital. And I think 2020 will be the tipping point of a new wave of human capital and a whole new set of talent coming in. And if you want to encourage institutions to maybe push the boundaries and do something that maybe they've been sitting on the edges, I think it's not just money. I think a lot of times we forego the talent component. The thing that really excites me about this space, other than everything we've talked about, is yes, it brought in the early, folks who believed in the ideology, and then, the technologists and maybe crazy people like us who just decided to lean in and take a risk. But more and more I'm hearing and seeing people leave really good, legit mainstream jobs, like operators and, service providers, and kind of give it all up and kind of really dive into this. And I think talent is a leading signal of kind of where our industry is going to go. So I'm very bullish about that.
Great. Well, thank you. And just to piggyback on what John said, the time horizon once people make a decision can often be pretty long. We recently had an announcement with State Street, and it took them 2 full years to go from concept to implementation. And so that's the kind of time horizon it takes for some of the larger institutions to get into the space. So we can fully appreciate the due diligence efforts behind getting everybody over the finish line.
I don't envy your long sales cycle. Kudos to you guys.
Speaking of the finish line, I think we've come to our finish line for the day. So thank you all to the panelists, and I'll turn it back over to John.